name's Dan Davis, talking with you today from ADK Wealth Advisory Group in St. Louis, wishing you and your family and friends a very Merry Christmas holiday season. Purpose for today really is to look backwards over 2016 and then look forward through 2017. I think some of the key events for 2016, first, if you look at what people expected, because it was such a big election year and some of the stuff going on in Europe, we really expected quite a bit of volatility. And that's what we started with. The first 6 weeks, you saw the S&P 500 pull back a little bit over 11%, categorized by us as normal volatility, still uncomfortable. But then because it was normal volatility, you saw the markets, say mid-February, start to snap back up and recover following a unexpected outcome in Great Britain with the Brexit vote, really on two levels. First was the bookies in the UK did not expect the outcome. Second, when the outcome did play out that they were going to leave the EU, most thought it would create a lot more disruption, but it really was just a matter of a couple days for the financial markets. One might ask why. It's my opinion that the reason why there wasn't more volatility was that so many of the central banks throughout the developed world, the UK, Bank of England, Bank of Japan, the ECB, are in what you would classify as stimulus mode, where their policies are very pro-economy. And so as a result of that, you have people willing to take more risk. If you then fast forward to the November election again, an outcome that wasn't expected, both on the level of the election itself, as well as what the financial markets had produced. Personally, from all the reading that we had done, we really thought that Clinton would end up winning. We know that Trump won. We believed that there was a possibility that Trump would win. If that was to occur, we thought the markets would respond like a Brexit. But what occurred is even more astounding to me is that it was a 12-hour period of time when you look at the futures market to the close of the following day, where the markets plummeted, but then by the end of the day they had recovered. And then we've been on what's been called the Trump terror since. And now I'm a little concerned that the financial markets are a bit overheated. We're not in bubble territory, in my opinion, when you look at valuations, but we're certainly at a level that's not healthy. It's the sage advice that I received from Oppenheimer back when I came in the business in the late 80s was, don't invest based on your political affiliation. The day after the election, I had some of our clients that voted for Clinton call me up asking, should we pull out? The same day, I had people who had voted for Trump asking me if they needed to take more risk. And so whether you are on the side of a Democrat or the side of a Republican, what I would say is look more at the fundamentals. Look at the economy, look at valuations, look at corporate earnings. And so when we do that for 2017, if you take a look, let's just first start with the economy. The economy itself has this whole Trump factor where we know that he's planning to do a lot of infrastructure spending. What we don't know is how much will get approved through Congress and how long will it take. But it's our opinion that we really won't see real effects from that until 2018. So if you take a look at the economy now, I think you could say in the U.S., we've recovered from the 2007 to 2009 financial meltdown. It's recovered, reset with a lot of jobs that are paying at lower rates, but unemployment is at a very low level. So I would say that you could comment that the economy is healthy and growing, albeit at slow rates. When you then take a look at Europe, that's where you really have more concerns. That's to me where the risk is really embedded. When you take a look at their economy, when you look at the West, you say Italy, really some serious bank problems. When you take a look at the east of Europe and you take a look at Russia, Russia's a quagmire in that you really don't know whether they're telling you the truth or whether or not they're hiding things. But clearly they have financial problems that if they roll over could roll through to European banks. The likelihood of those Italy and Russian type problems flowing through are hard to measure, but those are the areas that we would be looking at that if those buckled, we would take that very serious. I'll compare it to the beginning of this year. The beginning of this year was of concern, but we categorize it as normal volatility. So normal volatility is very different than something that could create a collapse. We don't see in the near term a collapse happening, but those two things could be potentials. When we take a look at staying still within the theme of the economy, if we look at Asia, there's where, if you haven't already watched it, we did a China video in 2016. I would go back and watch that. And what I would say is China's economy is shifting from a manufacturing to a consumption economy. They have a big challenge in front of them. When you look at total debt of China to the U.S. and you compare it to the size of their economy, they're both at high levels but reasonable. China's a little bit above us when you stack it. Where China really has the big issue is corporate debt. They're of the large economies, they're number one at the highest level of corporate debt. It's our belief that they're going to have some problems with that, and that where China will step in and help the local companies is when the people who are running those organizations are on the right side of that political communist regime. However, there are going to be people who are on the wrong side of that regime that I believe that China will allow to let buckle, and then they'll categorize it as corruption, and there will be some things that happen as a result of that. When that occurs, it will scare the markets, but I don't believe that that will be collapse. I think that, again, would be normal volatility. Latin America is going to be so predicated on what happens with commodities relative to oil and mining that it's kind of hard to say there, but they're more of a fueler for the real economies. Earnings, that's a spot of what I would classify as bright light. If you take a look at the third quarter for the U.S., earnings improved, but at a slower rate than previously. If you take a look at Europe and Asia, they're both improving at a better rate than the U.S. If you do a forecast for 2017, all three areas are expected to have double-digit growth in earnings. If that occurs, then my previous statement around valuations has a likelihood of going away. So earnings favorable, valuations I would say in the U.S. unfavorable. Historically, when you do an average PE over time since it's been tracked, it's about a 15.5. If you say what has been the S&P 500 over the last 17 years average, a little bit under 19. So there's a relationship between valuations on PEs and interest rates. When interest rates are at lower levels, it supports a higher PE. When interest rates are at higher levels, it supports a lower PE. We've been at a dropping interest rate period for some time. Now we believe that we're at the beginning of a period where they'll start to rise. Current PEs right now, as of December 1st, are at a 20. When we get above 20, I do start to have caution. Now, that said, I don't think that the markets have caution right now. I think that they have a real euphoric sentiment to them that I believe will carry on for a while. That's a bit like trying to guess the weather, I'll add. If you do a before the election, the PE on the S&P, whether you looked backwards, trailing 12-month, the forecast was like 17, 18, pretty much in line with the 17-year average. If we look at where the market was at the beginning of December, and we look at what the earnings forecast is, and we say what would be the forward-moving PE, it would be a little bit under 17. So a lot of our opinion of what's going to happen with valuations depends on earnings and whether or not euphoria continues to move the markets forward. We really don't know. The theme that we have is what I would classify as lower for longer. What I mean by that is whether we're looking at energy prices, inflation, growth rates on equity markets, interest rates, we believe the net effect of that is lower for longer. We don't believe that we're going to have a series of real negative or calamity type of issues. We do really believe that returns will probably be positive with a lot of volatility, but on the lower side. When we transfer all that to earnings, valuations in, say, for example, Europe and Asia. Valuations in Europe and Asia are projected 2017 much more favorably than the U.S. We're still very cautious. Europe has a lot of election issues going on that if they go the way of Brexit could create a lot of headwinds. If they go the way of Austria, then it would be a tailwind for the EU. So kind of yet to be seen on all that. When we take a look at Asia, very favorable for Asia. Asia has underperformed the U.S. for an extended period, And we believe that the Asian markets and the U.S. markets are really the two best places over the next decade to 20 years. Interest rates, if you take a look at pre-election, the U.S. Treasury was caught around 1.5. The election results all by themselves with no Federal Reserve move caused the interest rates to go up by a whole percent. That's a big swing in a short period of time. And then the Fed, as most believed, raised rates by 1/4 point. And then they signaled that they would raise rates 3 times in 2017. That is a change from their previous meeting where they had shown their hand to be 2 moves based on their data plots. LPL, myself, I believe it's probably more like two moves. And a bigger, more important component of interest rates is what's happening globally. If you're a Saudi Arabia sovereign wealth fund and you're getting ready to deploy capital and a certain amount of that's going to be in bonds, you're going to take a look and say, well, if I put it in Germany, if I put it in Japan, if I put it in the United States, what's my interest rate? In the U.S., as of today, the interest rates are above 2.5%. In Japan, they're under a 0.5%, and as well as in Germany, they're under a 0.5%. So that supply of money interested in our 10-year debt pushes our interest rates down while the Fed's trying to push them up. So there's a combination of global market conditions. So again, theme lower for longer. We believe interest rates have started to rise, but that they'll rise at a slower rate. We do believe that you'll have these periods where they spike up and then come back, but that the new set is higher than what it was before. We still believe that bonds, when we go out 5 years and come back, will do better than what cash rates will be. All of you have invested long enough where you know a lot of what I'm saying is our opinion. It's not a guarantee or meant to be a guarantee on investment performance. Rather, what we'll do is make sure we do our best to use our experience as well as our judgment to help you navigate through the times ahead so that we can do the best that we possibly can for you. And then if I were going to sort of summarize things, it would really be this, is that the euphoria of what Trump's going to do for the economy has rolled through to the U.S. equity markets. It has valuations at a bit of a high level. Concerned about that. If earnings happen the way that they're being forecasted, it helps that a lot. The next 6 months will really dictate whether or not we have concerns on valuations or not. We'll be steadfast on monitoring that and keeping in touch with you. If you take a look at interest rates, nothing that I would say that I didn't say earlier. We do believe that the Fed will continue to raise rates next year, but that global interest rates will have an impact on how slowly they move up. And then the economy in the U.S. is favorable. Europe has a lot of challenges, and Asia is on the right foot as well. So in closing, I want to thank you very much for your business, for our long-term relationship. It's hard for me to imagine that I've been doing this for close to 3 decades. Many of you, we've worked together since I was in my early 20s. So thank you for the trust that you've placed in us. If you're contemplating referring us to family or friends, probably the best way to do that would be to forward this link to them so that they can watch. When you do that, email us and let us know, hey, I'd like to refer you to our son or a coworker or a friend that I play golf with, and then we'll talk about the best way to move forward. If you haven't already liked us on Facebook or connected with us on LinkedIn, Facebook's ADK Wealth Advisory Group and LinkedIn is Dan Davis. I wish you and your family a very Merry Christmas and a healthy and prosperous 2017. Thank you.